Joanna, let's turn back to you. Where exactly are you seeing some of the greatest, at least opportunities with regard to the fixed income side of things? We've talked about things about treasuries. We've talked about maybe not as much about corporate credit, investment grade or high yield, other types of fixed income instruments. Where do things lie? Where do things kind of shake out with regard to where the opportunities are, given what we've seen?
Yeah, we're focusing our clients, we're focusing our message on corporate credit. And the reason for that is that you can actually see a balance sheet. You can see the strength in the balance sheet. We believe in the American corporate balance sheet because the fundamentals have been strong actually through 2023, 2024, and we entered 2025 from a strong position. So they are set up to weather this storm. And on the debt side, you know, if you're into investment grade, at the very least, you're picking up yield away from the treasury curve. But if you stay short on the corporate credit side, you're also not exposing yourself to undue interest rate risk, which is actually something we didn't talk about, which is really throwing the long end of the treasury curve around. It just has more interest rate risk because it has more duration. So if you take duration out of the corporate exposure as well in credit, you're really picking up some attractive yields at close to 6%. So, you know, it's something you should consider given, you know, investment grade rarely, if never, defaults. We like triple B. We like the triple B space because you get a yield increase from going out to triple B. It's still investment grade, and it's a place that you'll be picking up more yield.
Now, also, Joanna, the idea of trying to pick up more yield is something that is not mainly, but very often geared towards people who have an income tilt towards their investments. They want to see that kind of periodic paycheck, so to speak, right, coming in. With an income standpoint in mind, how exactly then do you go about constructing, whether you're a retail investment advisor, a registered investment advisor representative, any kind of a trader who wants to put their products into yield instruments, how do you shape a portfolio based upon that, given what we know in the ETF market right now?
I think it's the income. Maybe if we interchange yield for income, like that's what's really important about fixed income right now. Income is back in fixed income. And so for any investor, a sophisticated RIA that's trying to offset the volatility in their client's, equity portfolio, if they haven't looked at how income is serving that portfolio, they should. And so that's why we recommend, looking at these credit spaces because of the resiliency in their balance sheets, because of the resiliency of these corporations to be able to pay their debt. You should be reaching for not only investment grade credit, but also high yield credit, because the income is very compelling, especially in places like double B, which is a first rung in high yield. You're getting an immense amount of relative value from going from triple B to double B, an increase of another 100 basis points up to 7%. And so if you believe that you can see the cash in a balance sheet and you know that interest rate, that there's interest coverage for that corporation, that's uncertainty that you don't have to worry about. You can look inside.
Now, Todd, it's the income-oriented investor is also one that's looking towards the bond market side of things, but also balancing it out with what's happening with equities. I mean, we talk about the traditional 60-40 stock bond allocation and what exactly that's done for investors over the last few decades. Do you feel as though there are places right now on the equity income side of things that you are seeing more activity or heat in yourself from a strategist standpoint?
Yeah, I think what's super interesting since the market low, and even just income aside, is that there's just a total skepticism of what has gone on over the last month and a half. The equity rally has seen flows really cool down high level from the broader ETF universe. And then when you break it down by sector, there's been outflows from cyclicals such as financials, industrials, discretionary materials, and outflows from small caps and even levered funds. So the type of stuff that you typically see going very risk on coming off of lows hasn't been there. And for income, I struggle because you used to have utilities and staples be the bond proxies during the QE era, and that has disappeared with the return of bond yields, right? Of the return of a rate hike cycle. So I think the ability to buy something like consumer staples for yield has really deteriorated. There's not much of a reason to own a lot of these consumer staples names anymore, unless they're part of, say, an AI theme, like a Walmart or a Costco. But so other than that, I don't know if you're going to get much income flows to the equity side of the equation. It's all going to go to these short duration bond ETFs for now. But and then I also could just go back to this idea of the skepticism. I like that from the equity perspective overall.
Okay, Joanna, if you were to construct a portfolio for income generation focused on bonds, what exactly then do you do from a structural standpoint? How do you allocate? How do you systematically approach things? Do you make kind of one-off investments? Is it more about kind of like that 401k approach, which is like every couple of weeks or week or so, just put more money in and keep buying? How exactly then do you treat this income tilt in the market, given what we know about ETFs, mutual funds, and everything else?
Well, I think most portfolios, they're allocated to something that looks like a 60-40 portfolio. And so what is your 40? So normally the 40 is an aggregate exposure. And that index was built in the 1980s. And probably some of the ETFs you're using today have been built 20 years ago. So what we are saying is that if you're using, if you look at just like the space of an ag, you should be leaning into these income opportunities in corporates, which include high yield and investment grade, as I mentioned. Like, go and reach for the triple B yield. Go and reach for a double B yield, or even we advocate a triple C yield because, you know, at 10%, to Todd's point, like finding that income can be harder. Also, go into other asset classes like emerging market debt. And as well, you're looking for diversification into a really powerful tool in private credit. Private credit, in the way it's accessible today, it wasn't available to investors 10 years ago, 5 years ago. And now it's available in an ETF, and PCMM is our ETF. What you're looking at is a portfolio that has less than 3 months of duration, which is really low interest rate risk, and it's yielding, from a yield to maturity standpoint, over 8%. That's a compelling solution to what we were just talking about. A lot of people like to be short, and they want to be, but they also want the income. So to have high income and low interest rate risk, focused on, you know, high quality CLOs, like that's sort of a winning trade as well. So I would lean into what you already have, which is you have corporate exposure, you have treasury exposure, add you know, higher yielding corporates, and then as well, like, make sure you're looking at something like private credit, which is really diversifying, non-correlated, and has high income.